What's going, guys? Hope you're having an absolutely fantastic day. So in this video, I'm going to be talking about why Chinese stocks are absolutely mooning, as well as the state of the United States economy, and also my outlook for the US stock market, mainly the S&P 500. So let's start off with Chinese stocks, specifically Alibaba, right? So I'm just going to use Alibaba and Tencent as barometers of how the Chinese stock market is doing, right? So basically, you can see from the trough to where we are now, basically Baba is up a staggering 40% in like 1 month, right? So we can see over here, actually it's not accurate because the intraday low was 58, right? And I was quite lucky. I actually managed to buy at like 61 or something like that, right? But I didn't buy stocks, I bought some options. So I'm just gonna walk through why. So China Vice Premier signals shift in stance as some lockdowns are eased, right? So basically what this 9.6% run is because of China is basically lowering their lockdowns, right? They are not like fully or no more lockdowns like the US, but they are slowly signaling that they are slowing down their lockdown and that the lockdowns won't be so harsh in the future, right? Because of political pressure as well as people protesting and all that. So those videos were actually quite horrible. I don't think I've seen like China protesting like that basically ever in my life, except maybe before I was born, right? So actually we're quite lucky that they didn't do anything too harsh in China because maybe Xi Jinping or some Chinese officials might have taken the wrong thought process and basically tried to think that, you know, we can't let our people basically tell us what to do, and went and crushed the protest and all this, and there would be police brutality and all these things, right? And we are very, very lucky that didn't happen. If not, our Alibaba stocks will also be crushed, right? So the next topic that I really want to talk about is CPI, right? And I'm just going to use this interlink CPI and also the next Fed meeting, right? Because I believe these are going to be the macro events that will move the market a lot, right? So let me start off with CPI. I expect CPI to come in maybe at expectations or below expectations. So I don't make too much predictions, right? But I expect up to the CPI, we are going to have a rally, right? So this is basically my thesis for the next 12 to 16 or 18 months, right? So I believe that in the next month, up to CPI and also the Fed report, and maybe even after that, the market will be running, right? Because everyone is now focused on the Fed is going to slow down rate hikes and the Fed is not raising rates so much. So therefore, everything is good. You know, multiples might continue to expand and all that, right? But I think this is where I think they are very wrong, right? And I'll go through the data and why I believe this, right? So let's take a look at this. This is the most important thing that I've seen, right? So Dow gains 1,200 points and Nasdaq surges 7% in a blistering rally following October CPI report, right? So basically CPI was lower than expected and the market basically zoomed, right? And this is where I think the markets are overreacting, right? Because we do know that at the back of our head, we do know that if you want inflation to come down, economic activity has to slow, right? So I believe we have already been through the multiple compression part of the equation, right? But if you take a look, actually, we are now only down 13.5% of the all-time highs, right? So I am going to share what I'm going to be doing at the end of the video. So do stay till the end of the video, right? But I do want you to see the data before you just see or maybe copy what place I do. But I strongly advocate you don't do that, right? Because this is my research and I'm just sharing it and I'm just using YouTube as a digital journal, right? So next thing we have to look at is Powell signal Fed is ready to slow rates in December, right? So Chairman Jerome Powell signaled that the Federal Reserve will slow the pace of interest rate hikes next month, while stressing borrowing costs will need to keep rising and remain restrictive for some time to beat inflation, right? So not going to go through the whole thing, but basically this is also a reason stocks were up yesterday. Basically, Jerome Powell came out and said, oh, we're going to slow interest rates, right? So basically 75 basis point hike is basically off the table for the December meeting. So I think everyone is already expecting 50 basis hike. So I don't think that was quite the big news. I don't know why everything rallied like 10%. You know, like even Meta was up 8% after this speech, right? So I'm not complaining that my stocks are going up, right? So continue going up for all it's worth, right? But I just genuinely don't understand what was the fuss all about, because this is already baked into expectations, supposedly. This is just some confirmation, right? So the gist of this whole thing was, he said that the terminal rate actually is going to be higher than they first expected, which their expected was 0 to 5.25%. That's what I believe. So I think I'm not an interest rate predictor, but I think it'll be higher than that, right? I think it'll be maybe 6 to 7%, that range, right? And that's a wide range, right? So this is clearly not baked in the market, right? Because if we take a look at 10-year yield, we're currently sitting at 3.62%, when they have already came out and said we're going to end up at 5%, right? But some of the equation is also that people believe that they will hit 5% and then start cutting, right? And I believe that they are wrong, because I believe they'll be even higher and then they won't cut, right? So that's why I believe. And if we take a look at a tweet from Chicken Genius, right? So a picture is worth 1,000 words, right? The majority of the decline in this bear markets occurred after the Fed pivot, right? So everybody now is like banging on the tables hoping for the Fed pivot, right? So I just want to show you this and get your thoughts on it, right? Because we always have to remember that markets are reflexive, right? So basically, the reason that the Fed even cuts rates, right, is because the economy is not doing well, right? And if the economy is doing very poorly, right, that means stocks will be doing not so well as well, right? Because don't forget, when the economy is doing poorly, people expect earnings to be weak, so the multiples that they're willing to pay might be very low, right? And that is also a huge opportunity of when we want to be buying stocks, right? So sometimes analysts will be too pessimistic, guidance from management will be too pessimistic, and then at the same time, the market is scared, right? Everyone's scared to lose money, so the multiples that people are willing to pay are basically shrinking, right? So the opposite happened during the 2021 bull market, right? Basically, economy was strong, the management guidance was high, and forward PEs were extremely high, right? Because people are betting that this growth can go on forever, right? And on the downside, I'm telling you right now, the same thing will happen. People will think this will go on forever, right? It will keep going down, it will keep going down. Everything is going to zero. That's why people will think in a real panic, right? So the next thing to look at is actually credit card debt, right? So how much credit card debt do Americans have? So Americans' total credit card balance is 925 billion. So this is from LendingTree, right? So I've seen other sources that it was in the trillions or something like that, but maybe that is just consumer credit, right? Maybe that's different. So what I know is, and what I see is, all these metrics are all hitting all-time highs, right? Which lead me to believe that we haven't seen weak earnings, right? Because everyone is just borrowing because they believe that this will be a shallow recession, we'll move past it, I'll still have my job, right? But I don't think we can see the bottom of any recession, right, without job losses. That's what I firmly believe. Because when the job losses come, then all your debts that maybe you borrow on one credit card to pay off another credit card, those will start to unravel very quickly, right? And that's why when you take a look at this picture, right, all the declines are extremely sharp, right? That's the reason, right? Because the deleveraging is fast while the leveraging up is slow, right? Because after everyone has been burned, all the banks have been burned with losses, they will extend credit out only to the most worthy credit-worthy people, right? And when they run out of those options throughout the cycle, more people that are unworthy for credit will start to take on credit and will start to basically borrow money that they won't be able to repay. And that's what leads us to the next cycle, right? So that's what we have to remember. So Black Friday, this is something that people have been saying, oh my god, the consumer is so strong, right? But you can see that they embrace buy now, pay later, which is another form of a credit card, right? Amid high inflation and recession fears, but still drive sales to record 9.1 billion, right? So in my belief, right, if you inflation adjust this number, basically actually is lower than last year, right? But because all these are nominal numbers and not inflation adjusted, right? So first of all, I believe the consumer is weaker than all these things are showing you. And second of all, I believe that the consumers are buying on these discount dates, right? Because that's the only time they can get something that they need, that they didn't want to spend on a normal time, right? Because if you think about it, if you know Black Friday is coming up, what will you do? Instead of wanting to buy a rice cooker or whatever it is, then you don't buy and you wait for Black Friday to come. I'm really not sure what they sell during Black Friday, but I'm just using a rice cooker as an example because I'm Asian, right? So you buy the rice cooker on the Black Friday date itself, right? So everyone will clump out and they'll buy, which leads to record numbers. And this is not even a record number if you inflation adjust it, right? So that is why another point that I believe that the consumer is still weak. So if you're enjoying the video so far, do help me smash up the like button, hit subscribe, and also hit the bell button and press on all, right? So this will really help out the channel. And also watch till the end, right? Because obviously you don't want to miss any important information. Next, we take a look at the United States Housing Index. Basically, for the past 11 months, I think, the index has just been going straight down, right? So this is important because obviously housing provides a lot of jobs, right? And all the construction companies and all the real estate companies that depend on this market will also suffer. And I think that's coming in 2023 or 2024, right? Because all the projects that are currently being built were approved in 2021 or 2020, right? So all these apartment buildings, maybe shopping malls or housing areas will take maybe 2 or 3 years to build, right? So even though construction is still going on right now, by the time the inventory comes online, right, basically you can stay in it, you can rent it, no demand will be there for it already, right? Because I assure you that in 2020, a lot of developers went and developed because obviously you can borrow money for 0%. Why wouldn't you do that, right? So that's one thing that I also think. So next we look at the effective federal funds rate, right? So we can see that the Fed basically started raising in April, right? In April until now, it's about, I think, 7 months. So 7 months, and you look at how long the lag usually takes, right? The lag is actually 18 months, right? People expect 12 to 18 months, right? When you Google how long does monetary policy lag, right? And historically, this has been the case. So it's 12 to 18 months. So if they front load the hikes, I'm not sure what difference that makes. Maybe it will come faster because people cannot afford their credit card bills or something like that. Then they start defaulting left and right. They need to issue for bankruptcy and all that. Maybe that will come sooner, right? But that is why I'm also looking at this data and I'm getting quite bearish, right? So imagine if you buy a company, let's talk about going long, right? If you buy a company that is for $100 and you think it's worth $150, right? And the few months later, you get to buy it for the same $100, but now you think it's worth $170, right? So assuming that your calculations are correct, basically the second buy is the better buy, right? And right now it's the same thing. This position that I'm going to talk about later, I think it's better than if you did it earlier, right? Because the risks are actually increasing that I'm correct. So the signs that I'm looking at is actually more and more confirming that my views are correct, right? So some people might say, oh, you shorted, you are looking to short maybe like 1 year after the bear market has started, right? But actually, if we look at it, we have already entered and then exited the bear market and entered and exited the bear market, right? Just that this time I feel like this is maybe a little too exuberant, right? In the past, 15 days S&P is up 14% when the yearly performance is 10%, right? So this is where volatility and all kicks in. So next I want to look at the S&P 500 Yardeni earnings, right? This is Yardeni's predictions and also the analyst estimates, right? So for 2023, their estimates is 231 and Yardeni research is basically 225, right? So let's look at 231 and look at this in 2022. So basically 220. I'm not sure whether they hit these numbers this year because the year hasn't ended. But if you look, it's just a straight line up. And I find this very, very particularly curious, right? And weird, right? Because imagine that you are entering into a recession, but the numbers are just going up and up and up for your earnings, right? And ultimately, I believe that, when all these companies are laying off so many people, spending will start to go down, right? Meta is laying off 10,000. Amazon is laying off people. So we haven't seen the tick up in unemployment yet. But I believe when we do see the tick up in unemployment, it'll be very fast, right? So this is why people also say shorting is not for everyone, right? Because the moves might come very quickly and then rebound is very quick, right? So let's just take a look at the picture again. So the moves down are very quick, but the rebounds are also very quick, right? So you need to know when to get out, right? So as for what I'm doing, when the S&P hits, if it hits 4,200 points, I'm going to start buying puts, right? Over the next maybe 3 months, right? Ideally, I will be doing it at the end of maybe December, somewhere around there, because I do believe a lot of people are going to be tax loss harvesting and all going into the end of the year. So that will also be a primary driver, right? But my long-term thesis is that I'm talking about long-term is in the sense that it's more than a year. So I believe in the next 1 to 2 years, we will have a recession in the US and it'll be quite bad, right? Because we're not seeing all the effects In fact, people are taking on even more debt to try to avoid the pain, which I believe either way is going to be very bad, right? So I think this is a very good risk-adjusted return bet, because basically if the Federal Reserve refuses to raise rates, right? So they don't raise rates, inflation will continue to run, which will lead them to need to raise rates even more. And if they do raise rates and they crush inflation, right? Basically, what will happen is the US will be in a recession, almost 100% guarantee. And at the same time, because earnings are falling, the multiples will also contract, right? So I do want to go back and look at the multiples, right? Because this short, what I'm going to be doing is buying put options, right? And that is basically using derivatives to short the market, right? Because I don't really want to short the market, because the upside is too little compared to the downside. But if you're doing options, then it's a different dynamic, right? Because the downside is more than 100%. The upside is more than 100%, and the downside is 100%, right? So obviously not the perfect time to short, right? The perfect time to short will be here, which was somewhere around here, right? Which at that time it was trading at a 40 price to earnings. So you can see that if it just remains flat, right, I'm going to lose money, right? But that's not really what I'm thinking will happen, right? So only time will tell who's right and who's wrong, right? So if we take a look at the PE ratio, according to historical, it'll be around 15, right? So if we take a look at 21 to 15, that's already a 25% or 27% downside, right? And if the earnings itself deteriorate, which is my main factor for doing this thesis, right, is because all the analysts expect earnings to continue to, go up in a straight line, right? Which I don't believe it will happen. I believe that earnings will get crushed, right, because of the high interest rates and all these factors that I've been talking about, right? So if the earnings itself goes down, right, can you imagine if the earnings go down 30%, which is not unlikely for a big recession, right? But even if it goes down 15%, right, I think the downside is around 40 to 50% for the S&P 500 from this point, right? So to me, this is actually a cycle extreme, right? And some people might have been saying, oh, why didn't you short here? Or maybe I didn't see it, and at that time I wasn't really that active in the market. But I see it now, right? And going forward, I think this is the best risk-adjusted return for my money. So another thing I want to talk about is the VIX, right? So it's actually running into a few of the lows, right? So hopefully there is a rally going up to, the Federal Reserve meeting. And that is when I'll be accumulating my positions, right? And I hope the VIX is like 14 or 15, but I think that's quite unlikely. So I'll aim for maybe 18 or something like that. Because implied volatility is also important for options and all that. Maybe I don't want to bore you guys to death with implied volatility and option Greeks, but it's quite important when you're looking at this, because if you are buying options at this kind of price, you'll get crushed by the IV crush, right? So basically your IV will be down like 41%, and it's non-linear. So this is my thesis and my thoughts for why I'm making this particular play on the S&P 500. So for this, basically this November-December rally, I've basically been quite spot on, and my portfolio is basically flat year on year, which is very good compared to what is happening, right? Because actually I've only entered during like, I think it was June or August during that time. So doing quite well, so I wouldn't be crying about my performance, even though I'm not making a lot of money and I'm losing money to inflation. So that's about all I wanted to share today. So if you did enjoy the video, do help me smash up the like button and hit subscribe, right? Because I am going to make a video about why China is getting more and more likely to invade Taiwan. If you guys are interested in that, do hit subscribe and also hit the bell button. And comment below, right? What do you think of my thesis? And give me some constructive feedback, so maybe I can think I'm wrong and all that, right? So with that being said, have a fantastic day ahead and peace out.